Sorry. All right, so we're going to start this weekend's review of swing trade frames with a max pain range compression case study in Merc, which we built at the swing trade workshop in Raleigh. It'll be an example of the swing trade one day at a time concept, wherein we use intraday turbo trading to make some money, which pays for the swing trade risk that we're willing to take overnight. And then we'll take a look at the daily trade management we've done on the swing trade using the RLCO framework each of the days this week. And then that will lead us into an introduction to new max pain range compression swing trades that are set up for this week. All right, so this was the max pain range compression trade frame for Merc from May 19th, 2014 in Raleigh. And what we had was a very favorable reward to risk ratio. It had closed down here around 58.6 or 55.8 and had defined support at 54.7. Some other initial stops we could use around 55.5 and 55.6. Our mechanical entry would have been around 56.2, and potential places where we could see this achieving and then hesitating, where we'd have to make decisions here in the purple circles at 56.6 at the Bollinger Band mean and the 30-period regression line. At the far side of the river around 58. And then at the far side of the floodplain around 59. The idea was we would use 59.6 as the 10-day high as a price target for computing reward to risk. And my idea would be that if it got above 59.6 is where I would be looking to add a second position. But because this went through some max pain, you can see that here in those 5 days of selling, I would be willing to consider going short at 55.5 as price fell out of the river if I saw weakness in the S&P. So if the market was rolling over and then this was already weak, then I'd be willing to short that and getting a second short position on if it takes out the swing low here, the real body of the swing low at 54.7. So what we've got is a critical state. We've seen enough evidence to think there's some room to the upside, a favorable reward to risk ratio in either direction. And that's the working definition of a critical state. So I've marked off in green and red where my mechanical entries are going to be. What I wanted to see was an orderly entry inside the yellow zone, which would be in here inside yesterday's range, and then taking out the green line where I could make my mechanical entry and then think about this as a swing trade. So let's see what happened next then. So this is Merc on a 10-minute candle on the 19th of May. And so what we got was an open here at 55.74. So we were inside yesterday's range. Sold off sharply down here to outside of the Z-score -3, outside the Bollinger Band -3. This blue line is the open, by the way. It comes down to 55.62, holds, and then turns around and starts coming back north. We buy it at 55.80 on a Z-score trade with a 20-cent initial stop. So our entry is at 55.80 with an initial stop of 20 cents, which would take it down here to 55.60. And then about 30 minutes in to the market, it's now taken out the previous real body high, and it's left the river and floodplain and moving up with strength. And you'll notice that this purple line here around 56.25 is the 270 period regression line, and that really lines up with where our mechanical entry would be from the trade frame we just looked at. That's where if it gets above this purple line is where we can buy this thing mechanically with a stop down here. So we're feeling pretty good that we got some price improvement on this based on the early action. And I just want to draw your attention now. These little black dots are a way I'm trying to calibrate my intraday stop technique. And I'm using a parabolic stop and reverse, but with accelerated factors of 0.2 and 0.2. The increase and the max at 0.2, that's at like 10 times faster than the conventional default position. So now on the third bar, and that's the last one we looked at, this price is now moving up on bars in the second 30 minutes and bar 4, 5, and 6. And as this is moving up, you notice that the dragon, which is this pink shaded area, has moved to the north side of the river and is moving up and acting as support. You see the 30s behaving really well. The 90-period regression channel is behaving well. And the parabolic stop and reverse is moving well and moving things up. And that's what I'm using to push my stop up. Now an hour into the day, this is where I am going to use some discretion to lock in a good trade. Now, the parabolic stop and reverse would be down here around the Bollinger Band mean, around 55.90-ish. I go ahead and move this up to 56.14, and then I'm going to keep it pegged here until the parabolic catches up to me, because I want to lock in that nice little move right there. But I don't mind this parabolic stop and reverse recommendations. I think those are reasonable compared to how I was moving it. And so now at this point, an hour into the session, the turbo entry on Merc from 55.80 is now at 56.13. So we're 33 cents to the good on a 20-cent initial stop. So we're holding about 1.5 R right about now. And that's not a bad place to sort of lock that in, because if it gets up here and starts to hesitate, I'm not surprised, and I wouldn't want to let much of that 1.5 go. And you'll actually notice with our price is actually at 56.28, that's really a mechanical entry was possible here. And at 56.28, we're actually holding 2.2 R, and so I'm giving up just a little over half an R by pegging this at 1.5 R until the parabolic catches up. All right, so now what we have, another 30 minutes in, and we're still on the 10-minute chart. The mechanical entry would have triggered inside here. We've got some sideways consolidation price action after I moved my stop up here, and we're tracking this. Now you can see another 30 minutes have passed, and the parabolic is caught up to my initial stop. Now I'm willing to take that once more, and I feel like I've improved my exit strategy by capturing or locking in some of this movement here. You see the dragon has caught up to it now, and the 30 periods right at the bottom of the candle. And now I'm in the position where if I want to convert this to a swing trade, I can do that by selling 1,500 shares out of 2,000, because my unit of risk is $400, and at a 20-cent per share risk, I can afford up to 2,000 shares. So I've got 2,000 shares, and now I want to convert this back to a swing trade. I have to sell 3/4 and lock in those gains. I can take that money and use that as my risk capital for the swing trade that's open, and I'll convert this to a swing trade using the mechanical stop, and now I'm good to go. What I like about this was I like the way that the 270 works as a price target for the upside when you have this large discrepancy between, a sell-off down here with the Z and then an acceleration back to the 270. That 10-270 looks to be an interesting way to describe short-term potential gains. So now what we're going to do is sell 1,500, convert it to a swing trade, and we've got 500 shares on. and that's money that was earned by the larger position during the turbo portion of this trade. So I've got my seed capital out of it now. If we go a little bit wider now and look on a daily basis, what we have is, so we're looking at Merc on a daily. Here's that 270 now. So it has a different look because of the different time frame. The last time Merc, which had been very good, pulled back and sold off vicinity of the 270. It then had a nice run from 54 up here to 60, so a little over a 10% gain. And now this time it has pulled back, this time just below the 270, and now got this reversal. And our entry was actually here on this this white candle. So we carried that one overnight. The next day was an inside day, so we're still working the MPRC trade, and I'm glad that I'm holding the risk capital here with money I've already earned on this. And I'm still looking to see it get up here around 59, but I would certainly take the 90-period regression line at 58. So that's sort of a turbo and a core, where we start with a turbo and then leave a residual core position in. So now the next day, next couple days go by, we're still holding this thing. There was that red sell-off day. That was our essentially worked out to be our entry on the turbo day. We're now holding it at 56.56, and it's moving well up here. The next place I think that it has a hesitation potential is up around 57.25 when it closes the gap on this big red candle. If it hesitates very long here, I'm going to go ahead and take that, because that would be about an R in hand to get to this spot. So we're essentially working with an entry around 56.30 when you add slippage, with a 60-cent stop. So if it gains another 60 cents from this entry, it'll get up. This would be a little over 1 R in hand at the first purple line. We'd like to see it get all the way back up here, but that's the next decision point that we see. And this is sort of a natural unfolding of this maximum pain, range compression, and now starting to resume back to the original trend, which was up, as indicated by the 270 and the 90, and as you can see by the price action here in the 30. So this was the measured pullback that gave us an opportunity to buy quality on sale with a favorable reward to risk. And now on Friday, what we're looking at is it closed very well, one more day, and now we're almost at 57, and so I expect some price action to happen of interest on Monday. You would be perfectly justified in having cash this one at the end of the day, not taking any over the weekend risk, locking in an R. But in my view, if we get any kind of follow through on Monday, then it should come through 57.25 nicely. And you can see the 90 has already started to flatten out, getting ready to hook back up. And then if we can get through 57.25, then the next stop I see is about 58.75. That'd be another 2R if it can get up there. So we'll just continue to monitor this one and respect our stops. So we will now shift to some other swing frames that are setting up now for this week. This one is Walmart. It was somewhere around 8-1 on the reward to risk, and you can see why. If we find that 10-day high is probably right up around in here, and we have a range compression happening in this little doji with a stop. So with a stop down here and some price, you have to enter not later than price entering the river, and then with targets around the Bollinger Band main, the far side of the river, and then the test of the far side. With only a tiny little bit of risk, you can see this sets up a really nice reward to risk ratio. The last time price was in this range, it responded with a really nice move. So 78 is certainly within reach. very favorable pattern. But by the same token, if it fails, along with broad market weakness, you could think about taking this one short. So that's why we call this a critical state. I like the fact that it's got higher lows as well. IBM looks almost the same. So this pattern finds things that are typically in this condition. Again, measured swing low here at 184-ish. 10-day high around 197. Range compression. You have to buy it not later than price entering the river. Price targets at the Bollinger Band mean, far side of the river in the 90-period regression channel, 10-day high, and the far side of the river. And again, if we get some failure on this one, you can see the 90 and then the swing low down here at 172 being targets on the downside if we get market weakness. Martin, yeah, the 10-day high could be 1, 2, 3, 4, 5, 6, 7, 8, 9. Looks to be about 192.80. That's how I'm reading it. Next one up is another MPRC, this time an AT&T, and standard kind of a pattern. You can see the harsh sell-off from 36.77. That's the max pain. It has given us a range compression in here, and so if that's our risk, that it's not going to fail, then we have a really nice reward to risk ratio set up on a retest of the 10-day high. But if it fails below that swing low, now it's falling out of the river, and you can see you have a price target down here around 34.50, and if that fails, down here to 33, which puts this whole initial burst at risk. So again, a critical state in AT&T. And that's this. All I'm looking for on this one is a swing framework that gives me reason to believe in an outsized move on a one-day pop or a one-day fail coming out of this critical state. UTX, same as also an MPRC. Again, from the swing high around 119.20. And here's the harsh sell-off down to 112. And then this tiny little range compression here on Friday. It's already re-entered the river. This was an MPRC from Thursday, which allowed an entry. So you could already be into this trade. But it is still favorable in terms of reward to risk, because you got 1, 2, 3, 4 units of reward given the 1 day's worth of range risk. And there's reason to believe that 113 or 114 will act as support. So UTX is a max pain range compression. Caterpillar has given us 3 days of recovery already. And again, it's small range on Friday and a retest of the 10-day high. Gives us a favorable reward to risk ratio. And again, if it fails below the swing low, you know, you'd be looking for 99. And then if that failed, down here to 96. So again, a critical state for Caterpillar. Oops, sorry. Sorry for jumping around. My mouse got a little jumpy. All right, so this is a triple screen in ExxonMobil. The energy sector has been very good, but ExxonMobil has pulled back a little bit. You can see the classic features of the triple screen. The long-term trend is well up. It's had a pullback below the 20-period moving average. and then has had a bit of a recovery. And we've got a favorable reward to risk ratio on the upside compared to its mechanical frame. So this is a nice way to play a continuation of a very strong sector. If it gets above 103.60, makes an all-time new high, and that's a place that you could look at adding a second position. So we want to get paid a little bit here on a retested 10-day high and be postured for breaking out to a new high. So that's typical behavior for triple screen. Now this is one that we've been it's not even in the prototype yet, but this is sort of what emerging concepts look like when we're talking through. We're discussing the relationship of the four regression lines, 10 and 30, and that's the blue line and the black line. And that's what gives us our regression line crossover patterns. But I've been actually looking at this 90 and 270 relationship because that gives you another pair of regression lines that act as a fast and a slow, and this is factor of 3, so there's some kind of fractal quality. The 10-period regression line times 3 gives you the 30. The 30 times 3 gives you the 90, so they have a fast and slow relationship now. And then the 90 times 3 gives you 270. So you get this 4 fractal dimensions that we've been toying with. And I like the idea of this 270 being a profit target as a return to the long-term trend. So in that idea, we started looking at setting up some screens for things that would give us a nice relationship where the 270 was up, but we've had a measured pullback on the 90, and then the 1030 crossover occurs, and now we're starting to see a return to the longer term trend. And so that gets you into a pattern like this for DDD, which is 3D Systems Corp. And we've already seen kind of a sideways quiet channel breakout here. And it didn't give back much on Friday. And so if this excursion continues, we're thinking you could see this, connect up around 66, and that would get you early into the break, almost like a washout pattern. So we're calling this the regression line fractal 4 of the 10, 30, 90, 270. And Bob Rourke has already started running some screens on this, and it comes up with patterns that I really, really like. It gives us a measured way to get into things that are starting to improve, but where most of the improvement is still ahead of us, and that's just to get back to the longer-term trend, which manifests in the weekly and monthly charts. So that it's looking like a way to get alerted to value early in the life cycle. So more to follow on that one. We don't even have anything written on it yet. We've just been talking about it this week in the chat room. But that's kind of what that pattern looks like. It'll be very adaptive. This is one in corn that we've been following this one for months. This is one that broke out of a consolidation pattern at the bottom of the channel down here, and so we have been tracking this thing all the way up, and it's recently had a breakdown out of the river down around Z-2, which sets up a nice little possible support level here at 3250-ish. And so now if we play this idea of reversion back up to this congestion area, we'd have to have an entry not later than 3325, targeting the Bollinger Band main on the far side. That would be our 2 units of reward, 1 and 2, and 1 unit of risk here. And again, with the idea that if it fails below this support level, then 31.25 is certainly available, as is the 270 period regression channel down here at 3050. So that puts corn in a critical state. So we like that idea. This is Brazil, and it's been so strong that I wanted to take a look at it now on a daily basis. So we're looking at Brazil daily. And here was that nice sideways quiet channel at the bottom of a great big sell-off. And you can see now how the 270 has rolled up. And right here we get a 90-270 RLCO, which sort of coincides with this move. You know, here was the 1030 RLCO. And now we've had first move up, one consolidation, second move up to 50, and then a nice measured pullback, and then 4 days in a row it's failed to fail further and sitting comfortably right on the Bollinger Band mean above this previous support level here. So the fact that it's holding support where it once was resistance is very favorable. So this is a excuse me, pattern 3 in the RLCO framework. We had an RLCO that cashed and now has pulled back and held support at the Bollinger Band mean and is getting ready to take off. So I like Brazil for another leg up. All right, so this is XIV, the inverse of the VIX. And it has broken out to an all-time new high up here around 37.50. And you can see the previous places where it consolidated and then had breakouts. It had follow-throughs each time. So I like this one as a potential. It's getting a little pricey when we look at the risk Z, which is up around 0.89. But at the same time, it can stay that way for a while. And we've already seen one harsh sell-off. This is just a reminder of what kind of sell-off it can have. So if you've got this as a swing trade, you've got to have a stop down here around 35, maybe even the one-day low, just to protect against that kind of harsh move. But it can also move up that far on these swings, as you notice here, that when the VIX is cratering, XIV just does very well. So we get paid for paying attention to that one. IWM is an interesting one for me here. Right now, the Dow and the S&P have been the real winners in the U.S. index space. IWM has been the worst. So while the S&P and the Dow have both broken out above this last swing high, and they're making new highs, this one is still suffering on a 10% pullback and finding support in this critical zone. Now, it's back to the 270. You can see this as really just one big long leg where it moved from, and now we're looking at weeklies, it moved from 77 to 108 and then rolled over and pulled back and found support. Now, if 108 fails, you know, we're looking down around here to 100, 95, and 90 as price targets on the downside. But given the rest of the strength in the U.S. market, a return to the 10-day high is just playing catch-up here, and that's a 10% move. And so to me, IWM is in an interesting position here. And we're in risk on for the risk Z, and we've got a measured target on the upside and a minimum risk on the downside. This looks like a favorable tactical trade on technical basis here in the Russell. This is the, by comparison, this is the S&P on a weekly basis. And just the blue circles, as you know, are just things that I'm always interested in. Here was the last time that it found support and then broke out of a sideways quiet channel. Back when it was around 136. Again, we're looking at weekly SPY here. And we've had, and it has never really come back and tested the 270. That trend is still intact. And these next blue circles are all places where the sell-off came back towards the 270 but never achieved it. And in all those cases, it was coming back to the Bollinger Band mean. Only this one time here did it actually come across the Bollinger Band briefly. This last pullback didn't even get to the Bollinger Band mean. So we have something like a cushion around 183. A couple other things I would look at is now the 90 has come out of the floodplain, but the 270 has weakened. What that says is that the long-term trend has weakened, is strengthening. Let me restate that. The 90 period has come out of the river and the floodplain, and now the river is leaving the 270 behind. This is evidence of increasing strength on a long-term basis. That divergence between the 270 and the 90 is getting wider. It's a little hard to see, but just based on where they are with respect to the Bollinger Band mean, you can see that that's the case. So this actually says that the price action of the last 2 or 3 weeks the market has started to leave this choppy area behind and is starting to expand again. So those two events right there seem significant to me. Okay, now to take a look on a month, we're going to dial up now to a monthly, and so now we're looking all the way back, 4 or 5 years. Here was that pattern 7, the RLCO, outside the floodplain. That's a z-score of less than -2, and this is just a reflection in here that this has not been really a good recovery in terms of economic numbers, but really money has to be invested somewhere. And so on this one, you can see the pullback came to the Bollinger Band mean, to the Bollinger Band mean again. There hasn't been another test in the last 2 years. And now you have the 90 in green getting ready to cross over the 270. That's actually an acceleration of that long-term trend as it leaves all this gloom and despair behind. This has been a pretty remarkable move. And here's a period of 7 months in a row that we're up, 5 months in a row that we're up, and we're into the fourth one here. So there could still be 2 to 3 months worth of marching northward and not even be exceptional yet. So that's why I would say there's room to the upside in the market here. And we're at an all-time high, and there's no resistance overhead. Who's got a compelling reason to sell? I mean, if Putin can't drive this thing down, what's it going to take? Well, at the same time, the S&P's making all-time new highs. Let's take a look at our brethren to the south, and it's like the other side of this thing. After a really nice move up here off the bottom, Brazil did nothing but sell off back down to 40, from 85 down to 40. It's a 50% loss. And yet in the last 4 months, we've had a lot of outperformance, and it's just now putting in that base. So getting on the monthly chart, getting to 55 and 75 is not out of line at all. The road ahead to 55 is pretty clear. And so I'm pretty bullish on Brazil, and we can see already that when it accelerates and people believe in it, it can really go. And with the U.S. already fully priced and nobody loving Japan, and Europe already near its all-time highs, there's still room in emerging markets and Brazil to recover. So I see that as a really favorable opportunity. And you could almost, with a wide stop, buy Brazil and sit on your hands, come back in a year, see what you got. Russia up next. So this little sell-off here was part of that whole Crimea and Ukraine sell-off to get it down the favorable Z-score. And it's much like Brazil and has more tactical reasons to hate it. But, you know, with a $4 stop down here, I don't see why you wouldn't be interested in Russia, especially with the strength in energy and oil. And if there can be any kind of political resolution out of Ukraine, this should recover that price action pretty well. India on a monthly basis. Still very early in the story of India. I mean, this has been nothing but a 2-year chop. And yet, you know, the previous swing high is up around 40, and it's only at 24. You have to love that potential. And people are waking up to that. It's not China. It's not Russia. It's not Brazil. It's India. Turkey was in our list there on the ETF2 and the blended monthly rebalancing. So just as a way to take a look at this thing, we may be a little late to the party on this one, but it's been on our charts here for a couple months. And that's what healing looks like, this double bottom down here around 40. Yeah, 64 and then 74 on the upside, certainly. That's a tactical trade. I think India is in better shape. Gold is an interesting one to me on a monthly basis. It may have found its new intrinsic value in here around 1,200. I mean, that's a year's worth of doing nothing, which means a year's worth of failure to fail. And then if you still believe in the long-term effect of the printing press, you know, 140, 144, 164, 184. I could make the argument for accumulating gold quietly here. Silver is sort of the same pattern, but not as strong as gold. Now we're looking at silver wheaten, which is strongly correlated to price of silver. But you can see all these gyrations in here driving the traders nuts. But it's kind of stabilized in this 18 to 25 range. And it's favorable right now around 2130. You don't have much risk. And your upside potential, 1, 2, 3, 4, to get up here to the 90, 33. I mean, that's what I look at. It's cheap to buy silver now. And one more. This is what strength looks like. And just the only concern I have is that XLV has been such an important component of our ETF2 symbol all along. But, I mean, man, there's an RLCO for you. Sideways quiet channel breakout. There's a support at the Bollinger Band mean, breaking out to an all-time new high. Continuation patterns. 4-month holding pattern up here after this nice run-up. But still, what's the downside risk in healthcare? We think the population is suddenly going to get young? I don't know. But this is one where you keep following with a stop and you respect your stops and you keep participating until price tells you that trend is over. But that's what a recovery turning into leadership looks like. You know, from 36 to 56, for crying out loud. All right, I'm starting to lose my voice here, but I just want to share with you those frameworks and that case study on the max pain range compression. Those MPRCs, and to a lesser extent the swing trades, are things that are designed to get us into these kinds of longer-term trends at low risk moments, and using markets money to pay for as much risk as we can, and then simply managing it. Now, I'm just trying to demonstrate here that the RLCO framework gives you the capability of interpreting price action on these different time frames in a consistent manner. And so you don't have to be a 3-minute trader. You can be a swing trader in this business and do just fine. So that's everything from Kansas. We're a little over an hour here, so we'll call it here, and I'll get this processed and uploaded to YouTube so you can review this. But the charts are in the chat room already in the swing trade room if you want to take a look at those frames a little more carefully. So keep your risk measured and your powder dry, and we'll see you in the chat room. Enjoy the day off tomorrow with Memorial Day. Give some thanks to a soldier and a family for the sacrifices they make for all of us. So take good care and good night.